back to the channel, guys, here at Future Trading with Mike. And this afternoon, I wanted to show you an example of a liquidity setup. Yes, where the market makers, the big players in the market have actually tried to fake you out, take your money, and keep the market moving back in the same intended direction in which you were trying to trade in. So without further ado, let's go ahead and jump right into the video so I can break this down for you. All right, so now let's take a look at this setup here, okay? Where the market makers grab liquidity. I talked about this almost 2 weeks ago in a video, and I want to show you this, a real live example, okay? Which actually happened this afternoon around 3:20 in this session here, okay? Now, all day we've seen the market making higher highs and higher lows all day long, leaving behind areas where kind of voids where the market can pull back to, which I classify as areas of demand, where there's aggressive buying that took place or came out of the market. So here we have the market making higher highs and higher lows, all right? It pulls back right here, all right? So this all unfolded around about 3:20 this afternoon, and I happened to be sitting right here in front of my chart, and I saw it, okay? And I said, let me make a video on this to show the team, to show the community here how this actually works, okay? Like I said, I made this, I talked about this topic a few weeks ago, or about, I think it's about 10, 12 days ago, surrounding liquidity, okay? All right? How the big boys, the big players in the market, they like to move price down to a certain area, whether it be right at an area or a high or a low, come right to it, tick it out, meaning break right below it, meaning they do not fully take out that low or take out that high, but wick that area. They wick it, okay? Grab liquidity, and then they move the market in the same intended direction in which you were trying to move, okay? So here's an example right here. Around 3:20, we're going to switch on down now to the 4 range chart so you can really see it, because here on the 12 range, we pull back to liquidity, but you cannot see the full magnitude of what took place here until we scale down to our lower time frame chart. So we'll look at the 4 range chart now. What do we see? Okay, just as we saw price making higher highs and higher lows on the 12 range, we look over at the 4 range. Okay, we see the same thing going on. Okay, price is following suit on both charts. Okay, all right, moving in the same direction. All right, so here's price makes a high right here at 1986. 39.86 right here, okay? Now, all right, price pulls back here on the 12 range, just like I said, to what? To this area here, okay? This area which I have interest in, okay? All right? And, these are the things I talk about because I want to explain this in full detail and break it down as I did in that video I talked about it, almost 2 weeks ago, all right? All right, so price pulls back, area demand, all right? Price pulls back, okay? We see it right here. It's hitting that area of demand right there, all right? Now, what do we talk about when we look for those areas of, identifying areas in the market where there's actually money resting, okay? Which is liquidity, okay? All right? Those are peak highs and pretty much peak lows. It could be similar highs or similar lows, okay? And what we actually want to see is price do what? We want to see price go up there, grab that high, break through it slightly, or go down and grab that low and break through it slightly, okay? But what we don't want to see is what? Price breaking right through that high, closing above it, grabbing that liquidity pretty much, and then pushing up, okay? All right? Most times we'll see that happen. Even in the reverse side of things, price making a low, imprinting a low, okay? Comes back down to that low, it grabs that low or pushes through it, grabs liquidity, and keeps in the market keeps pushing south. All right, but in reference to liquidity, here's the thing. Okay, the market, what we want to see is the market go down there. In this instance here, grab it, meaning breaking right through the low. Okay, and then turning back around and basically wicks right below the low, turns back around, and then shoots higher. Okay. Meaning that a red candle pushing to the downside does not fully break below the low. It just wicks it out. We get a red candle push to the downside. It pretty much get a wick of that candle breaking below the low, but not fully breaking below it. and then it turns back around, pushes up, okay? These are fake outs in the market. This is how they get your money, okay? And you must understand that. And this is the reason why I trade supply and demand, is because, and not so much support and resistance, not to say or to take away from anybody that trades support and resistance. It's because in most instances, you want to trade what? Where the move started at, okay? And I believe once people fully understand that concept, why be in a move when prices, say for instance, made a swing to the upside, okay? Pushes up, pulls back, breaks higher, okay? Then they come back and they trade right at the, I call it the neck of a swing versus the bottom end of the swing, which is the low. They trade right off an area of resistance, okay? Right off the area of resistance to go long, okay? Well, you're trading almost a 50% area of a swing. I like to get into the move back within the swing, okay? Back within the swing, the bottom end of that swing, the low end of that swing, okay? There's so much meat. There's so much more meat on the table, okay? There's so much more that you can take off the table if you wait for price to come back to the area where the buying started at. All that aggressive buying started at. You get in down there, you wait for the rejection, price rejects it, go long, okay? And then you have so much more room to cover from the bottom end of that swing all the way back up to that high, the prior high, or the most recent high, okay? So and that's trading if you're looking for an area of demand. Here, in this case here, okay, price does pull back. It pulls back to this area right here. Look at what happens. Look at what unfolds. Look at the actual setup that took place here, okay? All right? Pulls back, okay? Makes a low, okay? Pushes up, pulls back, makes a lower high. Excuse me, a higher low. Pushes up, makes a high here. Now, I talked about in that video a few weeks ago what? Price making a low, pushing up, pulling back, and making a similar low. Okay, in this case here, price made a low here, pushed up, pulled back, we have a similar low. Okay, I want to see primarily a similar low or similar high situation, and then look for that liquidity, grab. All right, out of this area here. Okay, price pushed up, pulled back, two similar lows, pushes higher. Okay, now watch, because here it comes. Price then makes a high here. It starts to push down, okay? And what does it do? It wicks right below the low here. Does it close with a full red candle to the downside? No, it does not. What happens? Price pushes down. You have this green candle here, wicks right below this candle right here, this low here, turns back around, pushes higher, okay? Pushes higher. So, most people would probably be, in this instance here, because price broke structure over here, would be possibly looking for a setup to go short. But you gotta trade price action based upon market structure, based upon what price is actually doing. So there's money resting right here, okay? All right, and the market makers know this. They know that there's money resting right here. So they bring the market back down, like I said. They wick out the area. They grab money that's resting right there, okay? All right, they grab they grab your funds pretty much. Okay, and then they turn the market back around to push it up here. Okay, now me, I'm savvy enough to when I see setups like this happen and know what's going on. Okay, I take the opportunity, because when I see something like this happen, price making these equal lows right here. All right, and there's money resting as the market is pushing up right here. All right, in these areas, when it comes back and I see this setup right here, which is taking these little lows out, even on a 4-range chart. Okay, I'm gonna get into the trade. When the market, this candle flips back around, all right, right here, closes green, I'm taking it back up to the similar highs right here. There's a high right here, most recent high, and then there's another high right here. You have two equal highs right here. So, like I said, I see that flip of that candle, price wicking out below here, they grab liquidity, and I know what they're going to do. They're going to push the market right back up, okay? And at least, once I get into my trade, I'm at least probably, if I got 2 contracts on, this is what I'm going to try to do. I'm going to try to take the first contract back to the most recent high, and then allow the last contract or trail behind it and hopefully grab the next stop, which is these highs sitting up here. Okay, so that's how they like to move the market. Okay, that's how the big boys play, and you have to understand and play the same game and move the same way they do. Okay, because if you move it in the opposite direction against them, okay, if you're not moving in the same direction, they are going to stop you out. okay? Because they can pretty much see the stop sitting out there, and it's a big game of chess, and you don't want to be playing on the opposing side. You want to be playing with them, okay? All right. If not, then you're going to blow your account pretty quick, okay? So it is something myself I had to figure out, and it took time, okay? I'm not saying I lost a lot of money, but I wasn't foolish enough at the beginning to put a lot of money on the line or leverage my account, a certain size when I started trading, whatever the case is. Each time I wanted to go place a trade, I knew that I wanted to trade with small amounts, whatever the case is, so I could build my account up. And I highly recommend you guys doing the same thing. But yeah, I just wanted to show you this and bring it right to your attention, right before your eyes. Okay, so you can see, so you guys can see this just like I did unfold. And I hope you understand. And there'll be plenty more examples like this. Most times, like I said before, you'll probably see these type setups in the morning, somewhere between the opening session, 9:30 Eastern time, and possibly 10:30 or 11 o'clock. But sometimes you'll see them unfold throughout the day as well. It could be the afternoon session. And sometimes you'll see them, it actually happen not just on the 12 range chart, you'll see it on the 4 range chart. So if you're pairing charts together, you see demand pulling back up, demand setup or demand resting on the 12 range chart, price pulls back to it, and then you scale down to take your trade off of the 4 range chart. You may see that setup, that liquidity setup right there, off the 4 range, okay? But that's all I want to talk about in this video here, guys, today. Afternoon session, and actually the market is closed right now. So I'll see you guys in the next video tomorrow. Take care and be safe and have a great evening.